Welcome to Better Returns, where you will learn how to escape the volatility of the stock market by passively investing in real estate like a pro. 90% of millionaires earned and maintained their wealth by investing in real estate. We will share real-life examples from savvy investors so you can do the same. This show is for educational purposes only and should not be considered legal, tax, or investment advice. He has walked across the 5-mile-long Mackinac Bridge, which only allows pedestrians on it one day a year. Your host and my dad, Matt Hansen.
Welcome back to the show, Better Returns, Invest Like a Pro. I'm happy to have on the show today, Shawn Dwyer. He's the founder of Golden Oak Real Estate Investments. He focuses on acquiring mobile home parks and RV parks, and he really improves the living experience of the individuals that live in those communities, while also helping investors diversify their income and their investments by getting out of Wall Street. I love that. Shawn also has over 18 years of experience in the IT world, and he's worked his way up to an executive role in a Fortune top 30 company. So excited to have you on the show today, Shawn. So let's start off with a little bit about your origin story of how you got involved in real estate.
Sounds great. No, I appreciate you having me here today. So I got started in real estate many years ago in the single family side, doing some renovations, doing some fix and flips. And I liked it. I loved it. At the time, my family discouraged me from doing that. They said, go find a job in corporate company, corporate operation. You could be there for life. I said, okay, that seems much more stable. Still always had that real estate bug though. Just never really did a ton with it until I kept seeing my 401k, which was at the time my primary retirement account, just drop twice in my career, almost 30%. Once it was over a course of a couple years back in 08, 09, 2010. And then during COVID, much shorter time frame over the course of a couple months, you just see your retirement life savings just drop by like a third. So a little scary. So decided just to take a little bit of a diversification route, listened to tons of podcasts like yourself, read tons of books, and the real estate itch was always still there. So I was listening to a bunch of podcasts at the time that really focused it on multifamily, mobile home, and RV parks. And mobile home parks just really stuck with me. One, it provides really great value add for low-income housing for folks, which we desperately need all across this country. They're not building additional mobile home parks just because of the large cost and value that's there to build all the infrastructure, water, sewer, electric, roads, and then actually move on in brand new homes. It's very expensive. So you don't see many new ones popping up. So that's really what attracted me to get into mobile home and RV park investing.
You're the first one I've had on the show that's really talked about mobile home parks or RVs. So I think this is great. This is an asset class that I'm familiar with, but don't have the deep understanding that you do, Shawn. And I know that's been a bit of a challenge. It's always the not in my own backyard type thing. So it's hard, even not only the cost, but the zonings for new mobile home parks to come into play. So what are you seeing? Walk me through how you find these, who are you buying them from, and kind of what does it typically take to turn one around and make it a cash flowing good experience?
Yeah, so just like on the apartment side of things, there's a bunch of different ways that you can add value to mobile home parks. One, you can move in new homes. So the way that you evaluate a mobile home park is like any other piece of real estate, it all comes down to your net operating income, like how much money that business makes. On the mobile home park side, you have, for the most part, just lot rent that you're getting from your residents. Okay. This is a payment that you'd be paying to the owner, whether it be a mom and pop, corporation, it's a single person that owns it. You pay them a monthly lot rent, and then from there, they take care of the utilities. Typically, you would have propane or gas or electric in the tenant's name. And then all other utilities, water, sewer, trash are typically in the owner's or property manager's name. And then the tenants pay the lot rent per month, multiply that by the amount of lots that you have per month. Whatever your expenses, they could be all your utility expenses, insurance expenses, property management fees, lawn maintenance, lawn care, just general upkeep of the trees, the roads, the snow removal, all your expenses that go into it. You take that away from your reduction, and then that's ultimately what the value of the property is. So the amount of capital that you take from the residents for income minus your expenses is your overall net operating income. But there's a bunch of different ways that you can add value to properties. I can go into those if you would like.
Yeah, I'm interested in that because apartments, everybody knows that it's like flipping a house. This is a totally different beast altogether. So what is your typical improvements that you would do? Because you don't own the residents themselves, you just own the land and the plot, correct? Typically, is that right?
That's the more desired ones, right? So if you don't own the home, you don't have to upkeep the roof,
Yeah.
the water, sewing, the plumbing. Like, you don't have to upkeep any of that. The tenants own their own homes. They're called either tenant-owned homes or park-owned homes. Tenant-owned homes are more desirable because you don't have to do all the maintenance, the upkeep like you would in an apartment building. The only thing you have to upkeep as the property management company and the owners is just the roads, the infrastructure, the water, the sewer that comes to the home themselves. The residents take care of the homes.
Okay. So you come in and typically you don't want to own the homes. You just want to own the land and you rent the land. What type of improvements do you guys typically see you need to do?
So depending on the age of the community, there could be road maintenance, driveways, tree maintenance. That's usually one that's fairly neglected by the previous owners. Making sure that the water, the sewer infrastructure is really good, really solid. That don't have legacy properties that are originally built in 1940s, 1950s. You can run into some infrastructure issues there, just like on the apartment side.
And I had one friend that invested in, I think they passively invested, and they said septic systems are the worst in those so talk a little bit about why she told me that. She goes, oh, the worst thing, I'm always hearing about the septic. So what is the challenge with the septic systems in a mobile home park?
Well, there's actually multiple utility systems that you can have for sewer. The gold standard and the ideal one that you would want to have, if similar to your single family homes or apartment buildings, would be public sewer. So that would directly connect to municipalities. That's your ideal one. From there, you have septic systems, you have wastewater treatment plants, and you could have lagoons.
Wow. Is there a preferred one you want? Obviously, probably the city sewer is the low cost for the owners for it. Is that correct?
Absolutely, yeah. You could have it. You could have it directly connected, and the owner could be responsible for paying it, and then gets reimbursed by the residents. You could have direct build. So the ideal unicorn property that you would love as a mobile home park owner would be 100% tenant-owned homes and direct build utilities, water, sewer, trash, electrical, propane. That would be the ideal unicorn property that you would like to look for.
Gotcha. And so your improvements were mostly to the road, just the surface stuff, landscaping. Do you have any amenities typically in a mobile home park? Do you have any type of amenities?
It depends. So some communities could have basketball courts, playgrounds. You could have 5-star mobile home parks that have pools, recreation centers. But those are they're affordable housing, but they're higher end affordable housing. So you could have 55 plus communities that are more senior based, and you'll have a lot of those amenities. If it's an all age community, you could have playgrounds, like I said, basketball courts, dog parks. It really depends on the community itself, how much land you have, and what is really driving that for the residents to be there and live in that community in that area.
Yeah, so you tailor to your market, like you said. If it's an over 55, you're gonna have different amenities than if it's workforce housing, like we do with some of our multifamily stuff then too. That's good. So what markets are you where do you buy these? What markets are you primarily looking at? Sure, anywhere in the United States, or do you how selective, and where are the most of them? Where are the most profitable ones, I guess?
Sure, they could be profitable anywhere. It's really like any sort of asset class. If you buy it properly, they could be very, very profitable anywhere. We love the Mid-Atlantic, Ohio, Pennsylvania, Delaware, Maryland, very strong Virginia areas. Yeah, they're all over the place. When I first built my database of what we have out here, at least in Pennsylvania, within my county of Pennsylvania, I didn't believe it, but there are about 75 mobile home communities that are just in my little county of Pennsylvania.
Wow.
Yeah.
You don't see a lot of them, they're hidden away, back in rural areas or whatever. That's fascinating.
Yeah.
And what size are they typically? How do you measure these plots? Why do you say that? Units?
They would be lots. Yeah, just
Lots.
total lots. Yep.
So what's the ideal size that's ideal to invest in?
Ideal, it would depend. If it's your first investment, I would recommend anything over 100 lots, just because it allows you to have a really good, strong on-site manager that you can pay for, and they either can live in the community or general area and manage that property for you. Anything smaller, depending on the utilities and the setup of the park itself, the community itself, it could be a challenge. But again, it's going to be individual mobile home community versus one another. If I was looking to purchase one here in the Mid Atlantic, ideally it would be 75 up and above.
Okay.
If you're looking for like really great assets that you can add a lot of value over the course of time, ideally 100 and up would be a good situation for you to be in as a GP or LP.
So it's the scale thing. The bigger, the better, really, because the same amount of work from a management standpoint. But in this case, I would say because you have set costs, your utility costs are probably fairly high because you have street lighting and things like that. And those are the kind of basically fixed costs. So the more tenants you have, the lower your fixed costs, because most of your costs are fixed. Is that correct?
Yeah. Most of them are fixed. Yep. So our utility costs, manager costs are all fixed. So the more vacant land, the more open plots of land that you have, the more homes you can move in, you can start to really drive value from that. So you were asking before about value adds. There's a couple different value adds that you could have as a mobile home park community and operator as you take it over. The easiest one is just increase lot rents. So if you can go from a $300 lot rent per month, which includes water, sewer, and trash, to go and bump it up to 325 or 350, that's an instantaneous value add without doing any heavy lifting, assuming that it's within market. You don't want to necessarily drive too much or drive too quickly ahead of market.
Excellent, excellent. So what other things? So if I'm new to mobile home park investing, as a passive investor, what are the key things I should be looking for when I make that decision? Because it's a little bit different. It's much different than large multifamily and the other things that we're doing here.
Yeah, one thing that I would definitely look at is just look at what the supply demand is, what the housing costs for that given area. So if you're looking, it's one of the first things that I look and underwrite for a community is what does it currently cost if I was to buy or sell a home within that community? What does it cost if I was trying to buy a townhome, a condo, a single family home in that area? If I can buy a single family home in that area for $100,000 to $150,000, I'm going to have an issue moving homes into that community and getting people to move in for brand new homes because they could buy something similar. They don't necessarily have to pay that lot rent. They can go and get a 30-year fixed mortgage, great interest rate, where when you get financing for mobile home parks or for mobile homes themselves, it's a totally different infrastructure with getting a interest rate and underwriting. It's not that 30-year fixed that you would see as a single family twin home or townhome or condo.
Oh, so you really do need to understand the market specific. Like we will typically look at the comps, the other apartment complexes around, what are they charging for rent and all those types of things, the amenities and all that. There's probably a little bit different because you're looking at more fundamental things like how can they finance their mobile home that they're going to put on there? What does the job market look like? We look at that as well too. So that's really interesting. I didn't factor that in. It's a totally different clientele, different criteria. What are
Absolutely.
so a typical syndication for a multifamily mobile home park? What does that look like? Is it a 5-year hold? Are they all value adds? I mean, is the cash flow immediately? Is it deferred? What's your business plan in general for these type of assets?
Yeah, that will differ between syndicator versus syndicator. But for us, we want to be long-term holders. We want to own these assets for 20 or 30 years.
Oh, really? Okay.
Yeah.
So how do you do it? You're syndicating them and your investors will stay in the deal that long?
100%.
And why is that? Why is that your business model?
Sure. So, we'll hold the property, depending on the debt that we get on it. If it's a massive value add, moving in homes, trying to drive rents, if it's a mom and pop owner that's drastically under market rent, sometimes we can get seller financing deals where we can get pretty good interest rates. Other times it's a very good, very stable asset that we can get, 10-year fixed rate, amazing interest rates. Right now, they're 5.5%, 30-year AM, 5 years interest only for mobile home parks. If we can get really good interest rates for that, we have investors that we worked with in the past where they just want to put the money in the deal. We'll do a cash out refi in a couple of years when we add additional value for lot rents, moving in homes, and really forcing and driving that value. So that's one way we can get them their capital back, but stay in the deal long term and own it for 20 to 30 years. We're not looking for that massive capital like snowball effect. We just want to maintain and own and operate that park from now till the end of time. There's no reason to sell if you have great assets.
And that's the business model I'd love to do with multifamily. But it's so much more difficult because in multifamily, after 5 or 6 years, you got to remodel the whole thing. Now you got to recapitalize. You need to bring in more money to do that. In this case, you don't have to do that. And that light bulb just went on. I did not realize that that's how you can hold them and not have to, because we're kind of forced to sell it after 5 or 6 years. We'll double the investors' money, but otherwise we need to have more capital come in to renovate them all to increase the rents. You don't have that element at all. Oh my gosh. Yeah, I think you've converted me. Shawn, I never occurred to me. I never really thought that much. Nobody's really shared this with me. So, and people, I get investors all the time to say, you know what, we were turning properties in 3 and 4 years in the last few years and double their money in 2. Well, they said, well, I don't want my money, but I would like to just keep it in and go for 10, 15, indefinitely. So you fixed that problem. Is here's longer term. You can just place your money here. We're going to refinance it at some point when you've increased the value. You give back a fair amount of share of their investment. So now they've got that return there of a chunk of money, and then they're still in the investment for ever almost.
Forever. Yeah.
That's pretty powerful. Now I get the attraction that people like. We shouldn't share this with everybody. From an investor standpoint, we don't want a bunch of competition out there. So what does the competition... What's it like right now? Like multifamily, it's really hard to find deals that work, that are profitable. Is it the same thing with mobile home parks? You're in the same situation?
It is. Yeah, it's similar, right? So we do a couple different marketing aspects. I do direct mail marketing, cold calling and building relationships over the course of time with mom and pop owners and operators that manage them today. We do look at wholesale deals. We look at broker deals. It's still the same, right? So it's people still looking for top dollar when interest rates were 3.5. They've doubled since then, so you can't necessarily go and offer the same sort of value. Over the last 6 to 12 months, we're starting to see a slow transition now here on the mobile home and RV side, where existing owners and operators are starting to slowly come around, and that's what we're hearing from brokers as well.
I don't think you're gonna have the issue like in large multifamily, people, these short three-year interest only loans that are now going to be due in the next year or two. They're going to have to either refinance or sell it, and it's hard to refinance. You probably don't see that as much because we're speculation there's going to be a lot of large multifamily available for sale because they just have to. That doesn't really happen in this market so much, do you think?
Not in the areas that we're really looking at. So there is bridge debt that's out there for some value add stuff that might be not ideal for what Fannie and Freddie offer. So if you're looking at anything that's less than 80-85% occupied, mostly park owned homes, a lot of infill, you can get some bridge debt for that. And those folks, depending on what they got from their investors and the interest rates that they currently have, they could be in trouble, but I'm not really expecting it.
Yeah, it's a totally different business model, and you're not forced to do that. Very good. Anything else about that market specifically that you think people don't know about? I mean, you would get my light bulbs going off here constantly of other things. I didn't know this. That's why it's such a great long-term investment. You don't have to remodel it every 6 years. You just need to maintain it. Any other things that you think the average person wouldn't be aware of?
I mean, the one thing to think about too is the communities that we look at have very heavy presence of double wide homes. So even they are called like mobile homes, they're not very mobile. They cost thousands of dollars to move to a new community or a new plot of land. So when you have a double wide home, it comes in on 2 different trailers. They put it on site. They mash it together. They put in the roof and all the vinyl siding and everything together, and then put in steps and decking and everything, and you hook up all your utilities to it. So when someone is moving out of the area for jobs, for relocation, for family, for whatever, they sell it to the next person. So you don't ever have a vacancy unless someone actually physically moves the home, which is very, very rare. So when you're looking at your pro formas, at least on the mobile home park side, you don't see a ton of vacancies. You don't see things drop as you're renovating the community. So as people leave and cycle through, you have your lot rents at a specific number. And then when they cycle through and then someone else moves in, depending on the area and what you're doing within the park itself, you could have rents that are maybe $450 for the entire community now. But when someone cycles through, maybe that jumps to $500 because that's market. So you can slowly transition people in the community faster if you have turnover. So similar to the apartment side, but we don't really have to go in and renovate everything because we don't own the home itself. They sell it to somebody else. That new person comes in, pays the higher lot rent because that's just what market is.
Oh my gosh. So there's no vacancy because if somebody moves out, they got to sell the property or physically move it. And they typically don't physically move it because of the expense. And
Absolutely.
unless you're moving to another park, that's fascinating. Another check for why, okay, that's pretty beneficial. So as a result of that, you'll see the cash flow pretty consistent because you don't have okay, you know what, it's summer and, you know, people move in the summer. So you're going to see your occupancy go from 98 to maybe 94 or 5. You don't see that at all. It's just pretty consistent.
Absolutely. Yeah. As long as you have a really good area, strong, people and job growth and consistent, as long as you don't have a sudden exit of folks or like what do they call it? Like a one job market town. As long as you're pretty diversified on your job market, you're good.
Excellent. Excellent. Very good. That's some fascinating stuff. I didn't know. Well, we're going to move to the lightning round now. Those are just easy questions I've been asking. Now the hard ones, Shawn. Here's the hard questions. 5 fun questions just to get to know Shawn a little bit better. The first one, what was your nickname as a child?
Flash. My sister.
Okay, now you got to explain that.
That was many, many pounds ago. But when I was younger, I always used to run and play sports and was pretty fast. So that was the nickname that she came up with me, was Flash, because we were into the superhero thing back then. I'm not that anymore. So
did your family members still call you that though sometimes?
No.
Well, they don't. Oh, you grew out of it. Okay.
Definitely grew out of it.
Okay, number 2, morning person or a night owl?
Morning.
It's too bad for you. Okay.
I'm good with it. I'm up. I'm at the gym at 5 a.m. I am working at say 6:15, 6:30, and before anybody comes to the office, I already have about 2.5 hours into work.
I'm impressed. I'm impressed. It's beneficial. Well done. Number 3, what would be the first thing you do if you won the lottery?
First thing I would do if I won the lottery. I don't know if it would be the first thing, but it would be one of the things I would always love to do. I love college football. I love Notre Dame. So the one thing that I would love to do would be to get an RV and just travel around the country and go to every game, home game or away game, and just tailgate and then just have a blast. Just go see the country that way.
Oh, that's fun. That's great. Number 4, if you could live anywhere in the world, where would that be?
San Diego.
Me too. I've lived there short too. Whereabouts in San Diego?
Don't know. I've only been there once, but the weather was awesome. The people were super friendly. Food was great. The only thing that I would have a little bit of hesitancy out there is just earthquakes. That's the only thing that I would not want to move out there for. But other than that, the weather was great. People were awesome.
I lived there for a while in Pacific Beach. Oh my gosh. The weather's beautiful every single day.
Pretty much.
Just incredible. So I'm with you. I love San Diego. It's wonderful. And number 5, what's the one piece of advice that you would give to new investors to help them get better return?
Know the asset class of what you're investing in and know the operator.
Gotcha. That's key. The jockey and the horse, both, not just one or the other. I love both.
I mean, you're putting your hard-earned money that took either months or years to kind of grow with that nest egg. You want to make sure that you're investing in the right vehicle and the right person. Excellent
advice. Very good advice. Well, Shawn, how can people learn more about you and the great things you're doing?
Absolutely. You can go to my website, goldenoakrei.com. You can also email me at shawn.dwyer@goldenoakrei.com and set up some time, reach out to me, let me know how I can help you in any way. We can set up a virtual coffee meeting and discuss. If you have any questions on the asset classes, mobile home and RV parks, feel free to reach out. If you're looking to get into the space as a GP or an LP, always looking to help and help educate.
Outstanding, outstanding. And that information will be in the show notes as well. I know I'll continue the conversation with you on the show. We're friends now about learning and potentially passively investing. And I think it's a fascinating asset class that I think it's overlooked a lot because just people don't know about it. So thanks for bringing a lot of value to our listener today. Appreciate it.
Absolutely. Thank you for your time.
Thank you. Bye-bye.
And that's a wrap. Thank you for listening to Better Returns, brought to you by Hanson Holdings. If you enjoyed this episode, please leave a 5-star review because it helps others discover this valuable content. If you would like to earn truly hands-off passive income, go to hansonholdings.com, where we help you invest in large apartment complexes to grow your family's wealth. See you next week with another awesome episode. Have a great day.